reverse mortgage does not work the way you think it does. Most people who look up reverse mortgages already think they know what one is, and most of them are wrong. Not a little wrong, not missing a detail or two, structurally, fundamentally wrong in a way that's costing them real money right now. I've been doing this for 20 years. I've had this conversation thousands of times, and the thing I've noticed is that the people who come in with the strongest opinions about reverse mortgages are usually the people with the least accurate information about them. Here's what makes that expensive. American homeowners 62 and older are collectively sitting on $14.6 trillion in home equity right now. That's a record high, according to NERMA's most recent data. And a significant portion of those homeowners have ruled out accessing any of it based on something they heard, something they assumed, or something a neighbor told them at a barbecue. So if you've already decided that a reverse mortgage isn't for you, I'd ask you to give me the next 12 to 13 minutes before that decision is final, because what I'm going to do is walk you through how a reverse mortgage actually works. Not the version from a Finance of America commercial with Tom Selleck, not the version your neighbor told you about, not the version that's been living in your head since 2008. The real version, in plain English, with real numbers. And at the end, you'll know whether what you believe right now is accurate or whether it's been quietly steering you away from something you should at least understand. In this video, I'm going to show you exactly how a reverse mortgage works, using plain language and real examples so you can decide for yourself whether it makes sense to look closer. There's no sales pitch, no pressure, just the mechanics. So let's get into it. All right, the first thing I want to address is the belief that stops more conversations than anything else, and it's the bank ends up owning your house. I hear this every week. It drives me nuts. It's the number one reason people check out before they ever get real information. And I understand where it comes from. It sounds logical. If you stop making monthly payments, eventually the lender has to get paid somehow. So they must end up with a house, right? Wrong. Here's what's actually happening. When you take out a reverse mortgage, you retain title to your home. Your name stays on the deed. The lender doesn't own it. The lender doesn't want to own it. What the lender has is a lien, a legal claim against the equity in the property, which gets settled when you sell, move out permanently, or pass away. That structure is identical to the mortgage you probably already had for the first 20 or 30 years you owned this home. Did the bank take your house when you had a regular mortgage? No. They had a lien. You had the title, you made monthly mortgage payments, and the lien shrank over time. The reverse mortgage works the same way. The lien just gets settled at the end rather than installments along the way. That is not a minor distinction. It's the entire foundation. If you've been carrying the wrong version of this in your head, I want that corrected right now before we go any further. So, if the bank doesn't take your house, how does it work? Well, a reverse mortgage is a loan, a federally insured loan in most cases. It converts a portion of your home equity into usable cash, which you can receive as a lump sum, a monthly payment, a line of credit, or some combination of those. The key difference from a traditional mortgage is this. You don't make monthly principal and interest payments. The interest accrues. It adds to your loan balance over time, and the full balance gets repaid when the loan comes due, which is when you sell the home, move out permanently, or pass away. Now, I know what the next question is. What happens if I live a long time when the loan balance grows to more than the house is worth? This is where the federal insurance changes the equation entirely. The most common reverse mortgage is called a HECM, and that stands for Home Equity Conversion Mortgage. It's backed by FHA, which is part of the U.S. Department of Housing and Urban Development. So you've probably seen HUD. Under HECM rules, your loan is non-recourse. Now here's HUD's exact language on that. The HECM is a non-recourse loan. This means that the HECM borrower or his estate will never owe more than the loan balance or the value of the property, whichever is less, and no assets other than the home must be used to repay the debt. So go back and listen to that again or read it again because it's important. No assets other than the home. If you live in the home for 40 years and the balance grows to $900,000 and the home sells for $700,000, the lender takes $700,000. That's it. In the end, you don't owe the difference. Your estate doesn't owe it. Your children don't owe it. The FHA insurance fund covers the shortfall. That's what the mortgage insurance premiums cover. That's what it's built for into this program. So more than 1.3 million households have used this program. It's not experimental. It's not fringe. It's a federally regulated, federally insured loan product that's been available in some form since 1989. Let me give you a simple example. Homeowner is 68 years old. Home is worth $550,000. No existing mortgage. Depending on current interest rates and where the HUD HECM lending limit sits, which is currently at $1,249,125, A borrower in that profile might qualify for a principal limit somewhere in the range of $228,000 to $246,000. The exact number depends on current expected interest rate and the age of the youngest borrower, but that's the total amount available to them through the program. They don't have to take it all. They could take a portion of it at closing in a lump sum and leave the rest sitting in a line of credit that grows over time. They could set up a monthly payment for as long as they live in the home. They could leave the full amount in a line of credit and pull from it only when they need it, similar to how a home equity line of credit works. The flexibility is one of the most underappreciated features of the program. There are closing costs involved, which I'll cover in a separate video. There's FHA mortgage insurance, which is 2% upfront and 0.5% annually. Property taxes and homeowners insurance are still your responsibility. Those don't go away, and you're required to maintain the home. But the monthly cash flow equation changes completely for a lot of people when they understand that they can access this equity without writing a check to anyone every month. So if this is landing differently than what you expected, go ahead and hit subscribe right now. I'm putting out new videos on reverse mortgages every week, and the next one covers exactly how much you qualify for, which depends on more than just your home value. And if you have a question you want me to answer, drop it in the comments. I read and respond to every single one of them. The second big misconception is about who reverse mortgages are actually for. The version most people have heard is that it's a product of last resort, something people do when they've run out of options, when the choice is between the reverse mortgage and losing the house. That was closer to true in the early years of the program before the rules were significantly tightened. The regulatory framework has been substantially overhauled since then. In 2013 and 2015, HUD rule changes added financial assessment requirements and meaningful protections for non-borrowing spouses that address one of the most serious historic problems in the program. But the people I work with today are not distressed borrowers running out of runway. I'll give you 3 profiles that show up regularly. Profile 1 is the buffer borrower. This is a homeowner with significant equity, solid retirement income from Social Security, a pension, or an investment portfolio, but cash flow is compressed because of healthcare costs, inflation, or both. They use the reverse mortgage line of credit as a financial buffer, something they don't touch unless they need it. The line of credit grows over time at the same rate as the interest is accruing on the loan. The result is a growing emergency reserve secured by an asset they already own, sitting there if they ever need it. Profile 2 is the Social Security optimizer. Financial advisors, listen to this one. Every year you delay claiming Social Security between 62 and 70, your monthly benefit grows by roughly 6 to 8%. Some financial planners now structure reverse mortgages specifically as a bridge strategy. You draw from the home equity in your early to mid 60s so you can let Social Security grow. When you turn 70 and the higher benefits kicked in, you can stop drawing from the reverse mortgage. The math on that trade can be pretty significant. Profile 3, the purchase borrower. Most people don't know that this version of the product exists. There is a HECM for purchase, which lets you buy a different home, typically downsizing or relocating with a larger down payment and no monthly mortgage payment on the new property. You use a portion of the sale proceeds from your current home as the down payment. The HECM covers the rest. You move into the new home with no monthly payment obligation. And I'll do a full video on this separately. So who is this not for? If you're planning to move within the next 2 to 3 years, the upfront costs likely don't pencil out. Closing costs on a reverse mortgage are comparable to a traditional refinance, and if the loan is only in place for 18 months before you sell, there hasn't been enough time to realize the benefit. And if leaving the specific home to your heirs completely free and clear is generally a non-negotiable, this just not just a preference but a hard requirement, then a reverse mortgage may not align with that goal. And that conversation belongs with a financial advisor before any decisions are made. Those are situations where the product is bad. There are situations where it doesn't fit, and fit matters more than the product. So let me close the loop. You came into this video with a version of what a reverse mortgage is. Some of it may have been accurate. Some of it almost certainly wasn't. Here's what I want you to leave with. 1, you keep the title. The lender has a lien. Your home is yours until you sell, move out permanently, or pass away. 2, the HECM is a federally insured and non-recourse loan. HUD's own language says you will never owe more than the home is worth, and no assets other than the home can be used to repay the debt. That's the guarantee in writing. 3, this is not a last resort product. In the hands of the right borrower with the right planning, it's one of the more flexible financial tools available in a retirement income strategy. More than 1.3 million households have used it. Whether it's right for you depends on your numbers, your goals, and your situation. I can't answer that for you in a YouTube video. but I can give you enough information that when you're ready to have that conversation, you're having it from a position of knowledge instead of fear. The next logical question after this one is almost always, okay, but how much would I actually qualify for? And that's the next video. I'll walk you through exactly how the principal limit is calculated, the factors that move the numbers up or down, and a real example using borrowers' ages and real home values. So the link will be in the description below, and it's also queued up in this video right here next. So I'm Josh Borba. I've been doing reverse mortgages for 20 years. I'm a broker, not a lender, which means I'm not tied to one product or company. I work for you, not the bank. If you want to run your own numbers before the next video, the calculator on my website doesn't ask you for your name or your phone number or anything personal. Just plug in the numbers and see where you land. Links below. See you on the next one.